In this week's video, we'll review some simple and incredibly powerful stock market charts. It's a daily chart of the S&P 500 index. We've purposely removed the date from the chart to help us review the chart in an unbiased manner. The lines on the chart are simple moving averages, the 180 in blue, the 190, 200, 210, and all the way out to the 220-day simple moving average. These moving averages are generic moving averages to help us illustrate basic concepts. Let's assume we were taking a technical analysis multiple choice test and we were asked, which two charts on your screen are the most similar? In this case, the answer is relatively easy. On the far left chart, blue, the fastest moving average is on top, and the slopes of all of the moving averages are positive. The same can be said here. Blue, the fastest moving average, is on top, and the slopes of all of the moving averages are positive. For our purposes, that's a full-bore bullish look. This chart and this chart, they really don't look anything like this chart here, where blue, the fastest moving average, is on the bottom, and the slopes have all rolled over, and on the right side of the screen, we have negative slopes, which is quite a bit different than the positive slopes here and here. If we add in another example and we're asked, does this chart look more like these charts or this chart? Once again, for the same reasons, the answer is very easy. This really doesn't look anything like this. Next test question. Does this chart look more like these charts or this chart? In this case, the answer is easy. This chart looks a lot like this chart. Full-bore bearish look, full-bore bearish look, and really doesn't look anything like these full-bore bullish look charts. We have one more chart to review on this portion of the test, and once again, it's relatively easy. If we were asked, does this chart in the lower right-hand corner of your screen look more similar to these charts or these charts? The answer is simple. Again, full-bore bullish, full-bore bullish, full-bore bearish with our trends rolling over. And if you're watching at home, the answers to these questions are really, they're not debatable. They're very, very simple. What can we learn if we add the dates back to the charts? This strong trend here, 1995, 1996, this strong trend, 1950 to 1951, strong trend here, 1984, 1985, and the one that looks similar to those charts is the present day, 2017, 2018. This chart is dated September 6th, 2018. In all 6 cases, we're looking at the same generic and for illustrative purposes only moving averages. If we look at them in isolation, it's very, very easy to see. The present day looks a lot more like these periods that featured favorable odds and really doesn't look anything like these periods with unfavorable odds. And clients and regular viewers know that we've covered the similarities between the 1995-1996 case and the present day numerous times, including this video way back on December 16th, 2016. And we've just shown that both the 1950 to 51 case and 1984 to 1985 case look very, very similar to the present day. And that was the exact same conclusion that we drew in the video dated August 17th, 2018. These are the two periods we're covering in this week's video. Here are the same two periods in the August 17th, 2018 video, 1950 to 1951. This looks a lot like the present day. 1984 to 1985, this looks a lot like the present day. This is a chart of the Dow from 1935 to 2018. We've just demonstrated in an unbiased manner that 1950 and 1984, similar to the present day. We also covered these periods in the August 24th, 2018 video. Here's the chart of the S&P 500 that we covered in that video, 1930 to 2018, 1950 to 1951 here. This point A is very, very similar to this point A here, 1984 to 1985. This point A here is very similar to this point A here. In both cases, good things happened for a long period of time. The stock market rallied for an additional 22 years and gained over 500% after this breakout. And in this case, the rally lasted an additional 17 years, and the stock market tacked on an additional 1,168%. And in that video, we said, if something similar happened in the present day, we should remain open to an additional rally that could last an additional 12 to 17 years, and the S&P could tack on somewhere from 200 to 600% in round figures. We've also just shown in our objective and hypothetical test in this week's video has shown that the present day looks very, very similar to the 1984-1985 period, which was the exact same period we covered in last week's video. In that video, we demonstrated that the period from 1982 to 1984, which is this period here, is very, very similar to the present day. And if you know your market history, you know after this point here and after this point here in 1982, good things happened for a long period of time. When we remove the dates, we remove our personal bias. Without the dates, it's very, very easy to see that the present day unequivocally looks more like these favorable periods and really doesn't look anything like these unfavorable periods. Which is the same conclusion that we drew attacking the problem from a different angle in the August 17th, 2018 video, 1950, 1984. This point and this point here really doesn't look anything like this rollover look here as the dot-com bubble was bursting in the 2000s. So once again, we're attacking the problem from a different perspective. Using these simple moving averages, we just demonstrated the present day is similar to these periods here. We came to the same conclusion using a different approach in the August 17th and 24th videos. And last week we attacked the problem using long-term DeMark counts and tied those into the early to mid-1980s. All of this speaks to the weight of the evidence. You can find these videos here by Googling the name of our blog, Short Takes. If you're sitting there at home, you may say these are simply lines on a graph. Clients and regular viewers know that that's not really the case. These lines help us understand what moves markets, which is the net aggregate opinion of all market participants relative to all subjects on all time frames. And as of early September 2018, even if we use shorter term time frames, we would still draw bullish conclusions. The present day market, this chart here, is well aware of any what about question you can think of. What about emerging markets? What about tariffs? What about the potential for a recession? What about midterms? If and when any of those what about questions becomes a problem, including valuations, this chart here will eventually morph into something like this or this. And that absolutely, positively may happen in the future, but it hasn't happened yet. Another question, if you're watching at home, could be, the present day isn't anything like 1950, 1995, nor 1984. That's true. No two periods in history are identical. The same can be said for these periods. The problems that caused the net aggregate opinion to roll over in calendar year 2000 were significantly different from the problems that caused the net aggregate opinion to roll over in late 2007, early 2008. From a simple perspective, when the net aggregate opinion is positive, we have bullish trends and favorable odds. When the net aggregate opinion flips over to negative territory, we have bearish trends and unfavorable odds. The weight of the evidence today tells us, just as any volatility from this point here, this point here, and this point here, volatility in this direction was eventually followed by higher highs. That's what bullish trends do. Any counter trend moves here were eventually followed by lower lows, because that's what bearish trends do. And since we've had some 100% normal and to be expected volatility in the first 5 trading sessions of September 2018, it's prudent to remind ourselves, in a period marked by strong secular trends, our goal is to navigate between a point A and a point B that could be several years down the road. And if we are able to avoid these common missteps, the reward can be great. In this case, a 232% gain. It would have been very, very easy to fall prey to these common missteps countless times between this point A and this point B, just as it would have been very, very easy to fall prey to these common missteps over the first 5 trading sessions of September 2018. As we've covered many times in these videos, traders and investors tend to underestimate in these 2 areas. Number 1, they underestimate normal volatility. Markets are frustrating, difficult, and volatile. And number 2, they underestimate the power of the primary trend, especially in periods marked by strong secular trends. This is a lot easier than this. Taking a step back and reviewing data on multiple time frames can help us avoid these common missteps, and it will give us a much greater probability of successfully navigating between point A and point B. With the benefit of hindsight, this looks relatively easy. How does the exact same 50-week moving average look today? The answer on September 7th, 2018 is very, very healthy from a trend perspective, telling us the probabilities favor higher highs after any bout of 100% normal and to be expected volatility. Will continue to take it day by day in 2018. And the only way that we can use charts like this properly is to head into next week and every week with that flexible, unbiased, and open mind, which will allow us to see when the weight of the evidence starts to shift in a meaningful and material manner. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.